Good morning, everybody. I was going to say Big Orange Tuesday. We'll go with that. Happy Big Orange Day. Every day is a Big Orange Day. My name is Jordan Brantley Pruitt. I work with the Office of Alumni Relations here at the University of Tennessee, Knoxville. And I'm super excited to be joined today by Andy Farmer and David Harrell. We're going to wrap up 2023 year in tax details and kind of get everybody ready going into 2024. Before I turn the floor over to Andy, I'm going to give a quick introduction and read his bio to you all, so I make sure I don't miss anything. So Andy Farmer is a 2015 graduate of the University of Tennessee, Knoxville, and began his career in public accounting in 2015. Andy provides tax services to consolidated corporations, closely held businesses and their owners, and serves various industries, including construction, retail, manufacturing, insurance, financial institutions, and real estate. He is a member of the Construction Accounting Network, American Institute of Certified Public Accountants, the Tennessee Society of Certified Public Accountants, and Andy currently serves on the board of directors for the Porch Ministries Incorporated and the Associated Builders and Contractors of Greater Tennessee. Now y'all see why I had to read it. I couldn't memorize all that, Andy. Andy, thank you for joining us today. We really appreciate you giving us some of your time. It's also my pleasure to introduce David Harrell, who currently has 22 years of successful sales and fundraising experience with an emphasis on relationship building and client acquisition and management. David's well-versed in multiple aspects of development, including major gifts, annual giving, prospect research, grant research, strategic budget planning, and special event management. Action-oriented individual with a strong ability to connect with individual donors to help them discover their passion and reach their personal goals while supporting their organization of choice. David and I get to work together at the University of Tennessee. So David, thank you so much for joining us today. We really appreciate it. All right, so we are getting ready to get started. For all of my folks in Middle and East Tennessee, I hope you are staying safe in this weather. Andy and I discussed being snowed in a little bit earlier, so hopefully if you're snowed in, you are joining us from a safe and sound location, but we hope you enjoy our time today. One point to note before we get to the end of our chat is that throughout the duration of today's chat, you can put questions for Andy or David in any of the comments on the streaming platform that you're joining us from. So whether you're on LinkedIn, Facebook, X, or YouTube, you can type in your questions in real time. We will receive those, and then Andy and David can address those questions for you at the end of today's chat. So we are ready to get going. I will be quiet. I'm going to pass the floor over to Andy. Andy, thank you again for joining us today.
Yeah, happy to do it. Like Jordan said, Andy Farmer. I'm a senior tax manager at Rhoda for Moss. Also, what Jordan was referring to, it looks like we got a little over 8 inches of snow where I live in Knoxville. So yeah, we're pretty much snowed in, and it looks like it's going to be very cold next couple of days. I don't know if we'll be getting out, but happy to come, live from my home. I'm sure a lot of people are. So I'm senior tax manager at Rhoda for Moss. So Rhoda for Moss is a regional accounting firm. We have several locations, as you can see. Our main location is in Knoxville, but we have, Nashville locations, several in the Tri-Cities, and we've now expanded into Virginia. We're about 150 person firm with several locations that probably a lot of places where you guys are. Some of the services that Rhoda for Moss provides: assurance, which is reviews, audits. There's separate engagements. Tax, which is individual tax, business tax, sales tax, about any tax that is needed from a business and individual side. We cover it. We have somebody in the firm that can meet your needs there. Business consulting, a lot of mergers and acquisition work. We do. We connect people with different banks and attorneys that we have relationships with, and just general business consulting, a lot for small businesses. And then client accounting services. This is a service that's been beginning to grow both in our firm and in the industry. A lot of people are looking to say, we don't really need to hire a bookkeeper, that just does our books, when we can, outsource it to an accounting firm who can take care of our back office accounting stuff. And they have more experience in seeing different types of businesses. So that's something that we offer too. some of the industries, I think Jordan touched on it too, but construction, real estate, financial institutions, a lot of government work, big manufacturers, and then we also have a lot of not-for-profit work, and then we work with high net worth individuals. But we really work with all levels of individuals. If you have a 1040 that has a little bit of complexity to it, we can help you out all the way up to, people that are working on estate planning with their high net worth. So we kind of touch, from the bottom to the top level of clients. So, that's a little bit about the firm. But what I was going to talk about today is both a little bit of business tax updates. I'm sure some people in the audience, own a small business or help run a business that some of these tax implications will come up. This is both 23 updates and then some going forward. And then we'll move on from after business into individuals and some retirement stuff. And at the end, we'll talk a little bit about some Secure Act 2.0 stuff. And so the first one, the big thing is meals. So during COVID 2020, the meals got changed from 50% to 100% deductible. Really what that was doing is helping out the restaurants. So, as we know, everybody was stuck in their house during COVID. They wanted to help out the restaurants that were not getting as much business. So they thought maybe we can make the deductions for meals 100% rather than 50%. Well, that has changed. That has changed back to the old rule starting January 1st, 2023 to go back to the 50% deductibility, which has been the rule for forever. But some of the common meals expense eligible for that 50% deduction is, business meals with clients, foods and snacks for your employees, in-office meals for employees, meals while traveling, and then meals at a conference. And one of the big hot topics too right now in the business tax world is one of the sunsetting provisions that came through the Tax Cuts and Jobs Act. The Tax Cuts and Jobs Act was what the Trump regime, the tax plan he put in, that was in 2017. They put in 100% bonus depreciation. That has started to sunset in 2023. 2023 went down to 80%, and that is planned to drop 20% each year through 2027. Bonus depreciation is that extra accelerated depreciation that you can take for tax purposes on equipment that is 15-year life or less. And then some other business tax items. 1099s are now required to be filed online. I know this is maybe something not everybody is aware of or maybe has to deal with. But the 1099s being filed online is a change that some people are probably going to notice in this next month. For more information on that, you can just look it up online on the IRS. But if you are filing more than 10 information returns, that is now a requirement. I know a lot of people did not have to do that before. And then another hot button issue is the employee retention credit. So going back to COVID again, a lot of these COVID changes are starting to go back. So that's why I wanted to bring this up. The employee retention credit, that 2020 credit deadline is coming up April 15th. So what that is when COVID hit, there was the PPP loan that a lot of companies got. And when it first came out, the companies could either do employee retention credit or the PPP loan. Well, the employee retention credit is basically a credit of your payroll taxes back to you if you employed people through COVID. Well, they have now allowed you to both, if you already took the PPP loan, to also get the employee retention credit. So that's been something that's going around a lot, and a lot of companies and people are getting letters in their mailbox and email saying, hey, we run a LLC that could help you with the ERCs. And I guess just be wary of who you're using to do your employee retention credit because there's a lot of scammers out there. It actually made the IRS's dirty dozen. They do that every year about hot topics of fraud and things that they're looking into, and that actually made the IRS's dirty dozen this year. So it's something that they're cracking down on. So if you haven't taken advantage of the employee retention credit and you're looking into it, please vet who you're going to use. So that was business tax. We're going out now into individual tax updates. We'll touch on retirement limits and due dates. There's a big change to the energy efficient home credit, estates and gifts, and then Secure 2.0. We'll touch a little bit on that as well. Individual tax updates. So we'll touch on some retirement. I know this is something that a lot of people can take advantage of still. So IRA and Roth contributions for 23, that contribution limit has increased to $6,500, and actually $7,500 if you're over 50. And that's for the 2023 tax year. And you actually have until you file your tax return to make that contribution. So if you've contributed $4,000, you can still, and you still haven't maxed that out, and you feel like you can give the $2,500 to max it out, you still have time to do that. That is until you file your tax return by April 15th, or even if you extend, you can still contribute even to the extended date. And then 401k contribution limits, they have increased to $22,500, and then $30,000 if you're over 50 years old to make that catch-up contribution. If you're an employee of a company, it's too late to max out your 2023 401k contributions, but some solo individual 401k plans still allow you to max that out. So if you have an individual tax 401k plan, you can still max that out by the same dates as the IRA by the time you file your tax return. A big jump in 23 percentage-wise was the energy efficient home credit. This is effective from 2023 through 2032. It increased from 10% up to 30% of the cost of certain energy efficient improvements to your home. That's a pretty big jump. There is some total credit limits, but the eligibility of what you're buying has went up 10% to 30%. There's a $1,200 limit on the most energy property that you buy for the credit, but a lot of the stuff you buy that 10% would not cover that limit, but now 30% gives you a lot more. So I know EnergyStar.gov, I put it on the screen there. That is a good place to go if you have bought energy efficient improvements to your home, because take advantage of that credit if you've done it. I know it's things like solar panels, of course, comes to mind, but certain types of windows, certain types of doors, light bulbs. There's all kinds of things that might qualify that you may not know. So EnergyStar.gov will give you that information. But also, it's not just your it's not just your primary residence. It's any home that you have as a resident. So if you have a second home that maybe you put solar panels in, or you put new windows, and you think, oh, well, those might have been energy efficient by the government standards, then look into that, because it can be an extra credit on your 1040 return. So an individual tax update, estates and gifts. So the annual federal gift exclusion, that is for 2023, that is up to $17,000 per recipient. And then 2024, it's $18,000 per recipient. And so what that is any individual can gift one person up to in 2024 up to $18,000 without filing a gift tax return, and also doesn't affect your lifetime exclusion, and that's per recipient. And then also, if you're married, it doubles. So your wife can contribute up to $18,000 per recipient. Husband can contribute $18,000 per recipient. So that's new this year. That's went up $1,000 for 24. But the unified lifetime federal exclusion, 2023, that was $12.92 million. In 2024, it is up to $13.61 million. Why that's important is that is set to sunset and revert back to what it was before, starting January 1st, 2026. So what that means is if your total estate is over the 13.61 million in 2024, you die, then the amount over that amount is subject to estate tax. And estate tax is brutal. State tax, the highest rate is up to 40%, and they don't give you much break if it's under that 40% either. It's high. If you get stuck with the state tax, it's going to be a high rate. But see, that 13.61 is reverting back to 5 million, adjusted for inflation. So we think it'll probably be around 6 or 7 million. But that's a big difference when you come to estate, the amount of your estate, the worth of your estate. So that now is the time to work on estate planning. If you own businesses or have a lot of high net worth, your property's worth a lot, and you have a lot of stocks and 401ks and things that you think are going to be over. Really, if it's going to be over that $7 million mark, you got to start working on your estate. CPA firms, attorneys, financial advisors, they can all help you with that. I know what we do with our clients is we take a team approach. We kind of look at, some of our clients that have those high net worth estates, talk to them about doing estate planning, right? We sit down meetings, saying, what do you want to do with this, with all your assets? We team up with their attorneys, team up with their financial advisor, come up with a good plan and get started. So I know we're starting to do that a lot in 2024 to try to lower the amounts of those estates before that January 1st, 2026 mark. So, and then another individual tax updates. So Secure 2.0 came out a few years ago, and it has changed a lot of things when it comes to retirement. So one thing that's new is the increase in qualified charitable donations or qualified charitable distributions. Before 2023, individuals who are 70 and a half or older may use a QCD to donate up to $100,000. So what a QCD is when you have an IRA or 401k that you have to make a required minimum distribution. So basically the government makes you take out so much of your retirement each year, right? And if you don't technically need the cash flow, but you'd rather not give it to the government, you'd rather give it to a charity, you can actually pull that required minimum distribution out of your retirement accounts and give it to a charity, really of your choice. So the change to that is now, starting in 2024, it has been adjusted for inflation, which has not been adjusted for inflation in the past. In 2024, it's up to 105,000, and it's supposed to be indexed every year going forward. So that's a good change. If you're kind of up to that $100,000 mark and you're used to making these, just know that it will be changed. It will change going forward. This is a good tax planning tool. This is a good tax planning tool if you really don't need that money out of your retirement account, but government's making you take it and you'd rather give it to a charity. This is a good thing to do. And then increase to the IRA required minimum distribution age. This is also a pretty big change. So back to what I was talking about, that required minimum distribution that you have to take, that the government's making you take. The age for the required minimum distribution is increased to 73 years old, effective January 1st, 2023. So if you turned 73 in 2023, you probably know about this already. But if you're in that age range, before, if you're not 73 yet, that has affected you. And again, it's going to change to 75 starting in 2033. So if you're around 65 years old right now, then this is something you need to pay attention to, because this will adjust probably around the year that you turn 75. So this is something to look into if you kind of fall in those age brackets, because it is a pretty big deal if you have a lot of money tied up in your retirement accounts. Then the last thing I was going to touch on for the Secure 2.0 is the one-time election for a qualified charitable distribution, just like we talked about in the slide before. That can now be made to a split interest entity. So these get a little bit technical, the split interest entity. So basically what a split interest entity is you can make a gift to a single charity, but in turn, you get some personal benefit as well as the charity gets personal benefit. So one of those is a charitable gift annuity. I know that University of Tennessee has the charitable gift annuity set up that you can do. And basically what that is you set the gift aside, you give the donation to the single charity, and then the charity takes it and puts it in a reserve account and is invested. And then after that, you will receive a fixed income distribution to yourself until you die. And at the end of that, when you die, if there's anything left, the charity gets the rest. And then also while you're taking that money out, there's a difference in what they're giving you versus probably what they're investing and making in the market, right? So there's double benefit there. So what's new about this is you can actually make your qualified charitable distribution, like we talked in the slide before, to a split interest entity, and it satisfies your required minimum distribution. I know that's really wordy, but this can be made up to $50,000 in the aggregate in 1 year. So this is a good plan, a good tax planning tool too. If you if you have money tied up in your retirement account and you don't want to send a lot of it to the government, this is another way to do it. But it has to be made from your IRA or retirement account assets. So, really that's it for the tax update. If anybody has any questions, and if not, we can move on to David, and then we can answer some additional questions at the end.
Thank you so much, Andy. We haven't had any additional questions come through on the streaming platforms. So just a reminder to our guests, if you have any questions for Andy or David, you can type those in at any time. No need to wait till the end of the show. We can hold those questions until the end. But I'm going to go ahead and pull the slide deck down, and then David, I will put you up on the screen solo, and the floor will be yours, my friend.
Thank you very much. I will have some overlap regarding some of the things I talk about that Andy has spoken about, but maybe I will add a few additional things and so forth, and do welcome your questions. Beginning January 1, IRA account holders that are 75 or above can contribute $105,000 to charity via the Qualified Charitable Distribution, or QCD, in 2024. Now, while the IRA QCD maximum was $100,000, with a Secure 2.0, it has indexed for inflation, and that's hence how you see the larger amount now. But in addition to that, and one of the areas I'd really like to speak to, let me back up one moment. Those funds can be used for your RMDs. I just wanted to make that clear. But the other area I really wanted to speak about today is additionally IRA account holders who are 70 and a half or older, who wish to create a life income gift utilizing the QCD, can contribute a maximum of $53,000 to the life income gift. This is an increase of $3,000 above last year's limit. Now, please note when we talk about this that it's more of a one and done type of opportunity. In other words, if you don't expend the full $53,000 over the course of this year, it can't be rolled over. So this is a one-time opportunity. There are some very, very strong positives here, but you also have to note that there are some taxation implications here with the proceeds. As a couple of the different things you could do, you could create a charitable gift annuity, as Andy mentioned, or a charitable remainder trust. So there's a couple of options there. These do count towards your RMDs. And as I mentioned, the proceeds from that income can be taxable. So we wanted to make that clear. That's the biggest thing that I had to say today. I did want to point out that if you've got questions or would like to look at implementing one of these plans, I'd be glad to talk with you. You can reach me at 865-604-4399. My office is here at the University of Tennessee. I'd love a chance to talk with you. We could talk about some of the implementation of some other things that, such as endowments and so forth, that we could talk about as well. So please let me know if you have any questions, and that's all I have for today.
Thank you, David. Andy, I'm going to put you back in here as well. All right. I just wanted to say again, thank you both very much for your time today and sharing your expertise with all of our guests who joined us. We really do appreciate it. Andy, thank you for being an invested alum and being committed to making sure that we can do programs like this for our alumni around the country. We couldn't do it without alums like you. So we appreciate that very much. And David, of course, thank you for your time today as well. Like David mentioned, you can reach out to anybody from our University of Tennessee Alumni Relations Office. We can put you in touch with Andy. We can put you in touch with David if you have any questions. I'm going to put Andy's slide back up here one more time so that way you have his email if you need to reach him at all. And just wanted to again say thank you both for your time today. Really, really appreciate it. As we started the show, I'll end the show with saying, please be safe out there, especially if you live in East Tennessee or Middle Tennessee. It is still pretty treacherous out there. And good news is they moved up the Vols basketball game against Florida. So we have something to enjoy this afternoon at 5 o'clock. So if you're going to the game, please be safe. And if not, let's cheer the Vols to victory this afternoon, of course. So thank you, Andy. Thank you, David, for your time. Everybody, we appreciate y'all tuning in, and we will see you next time.
Thanks, guys.